I think for the rest of the year, the labor market holds the key. It holds the key to sentiment. It holds the key to the market reaction. It holds the key to the Fed's reaction function. And it absolutely holds the key to what the consumer will do. Because even if they haven't lost their own jobs, hearing that somebody else did or seeing those numbers rise faster than they expected, the unemployment rate, it shakes sentiment. And it certainly did a couple weeks ago. It definitely has the propensity to do it again.
Welcome to the Monday edition of the On the Tape podcast. I'm Dan Nathan, joined by Guy Adami and SoFi's head strategist. That would be Liz Young-Thomas. Welcome.
Hello.
Lot to go over this week. What a week it was last week. Monday morning, I think when we were doing the pod, it was all out panic. And if you look at the S&P week over week, we are just flat from Friday's close. The 10-year Treasury is also flat. So there was a lot going on there. Maybe we'll dig into that real quickly. Guy, maybe we want to hit this Dennis DeBusschere comments. He is up 22V. You and Danny sat down with him, and that dropped on the Tape podcast feed on Friday. I thought it was a great interview. We got a lot of economic data this week. We have PPI on Tuesday, CPI on Wednesday. We'll see what that data shows and how that might impact expected rate cuts in the fall. Some data on growth as it relates to oil refineries here in the U.S., and then some earnings. We have some retailers, Home Depot, Walmart, Cisco, and AMAT. Liz, you spent some time this weekend probably going through all the rags from Barron's to Bloomberg to CNBC.com, all that sort of stuff. What do you think the takeaway was for last week? We started with, fear of Japan bringing down the global markets and the global economy. But the Monday morning opening in U.S. equities was the low print, same in the 10-year yield. How are you feeling week on week here?
Well, I'm feeling like, first of all, we're much more prone to volatility than we were a month ago. And when there's a couple reasons I would say that. First of which is that just mathematically, what you hear people say in the industry a lot is, if you're down 50%, it takes 100% to crawl back out. Just look at the amount of time it took us to get down that far, and then the amount of time it took us to crawl back out and just be at even, right? It took us the rest of the week. We had a few failed attempts. So Tuesday we failed. Wednesday, we failed. Thursday, Friday, we finally rallied to sort of recover it. But that was a 4-day period after 1 day of pain. So it just goes to show how quickly you can give back some of those gains and how quickly pain can happen. And that's why we say all the time, don't try to chase it. You can't catch it on the way down. It goes so fast. So you want to be prepared before that. One of the other things that was interesting that came out of last week is that when you saw the market reaction to initial jobless claims on Thursday. First of all, we haven't talked about initial jobless claims as a market moving number I don't even think this whole cycle we've talked about it. But now that we had that one scary unemployment report, that one scary jobs report, suddenly these weekly numbers are taking center stage. Mario and I did some work on this. I wanted to know how big was that reaction compared to other reactions on this whole cycle. That was the biggest one-day reaction, not even 1 day. That was the biggest 1 hour reaction to an initial claims number. So what does that tell you about the market? It tells you we are now, again, very macro focused, very data dependent, but even on smaller pieces of data. So on a week like this, where we've got PPI, we've got CPI, next week we've got Jackson Hole, I think we're going to see a lot more volatility. It could go in both directions, but I think we're going to see a lot more volatility on everything that prints.
Yeah, I agree with that. I think the optimists are going to point to this recent move and this snapback that we've had, and they're going to look back and say, you know what, it's run of the mill. It's the same thing we saw basically middle of March into the middle of April when, the market, I think at the time went from about 5250 in the S&P 500 down to about maybe we got down to sub 5,000 briefly, Dan, by the middle to late April. And they're going to say, you know what, it's the same thing we saw then, and we're just going to go back on our merry way. The difference, of course, being that we didn't see anything on the volatility front that came close to what we saw on Monday. And I'm one of these people that I don't think vol events like that are one-day events. I think, to Elizabeth's point, we're probably now in a period of time where the VIX is going to be a story, and you're going to see exaggerated moves both to the upside and the downside. So listen, the snapback made sense. It went a lot faster and a lot higher than I thought it would. But with that said, I still think a lot of damage has been done.
I think what most people expected was that going into Tuesday, we'd have this bounce just because we went down so far on Monday. Well, we're not bouncing just for the sake of bouncing anymore. we needed good news in order for the market to actually start recovering that. So that's something to note too, where the market isn't just going to recover just because, which also tells me dip buyers are not as fervent in this market as they used to be. So you need some piece, some evidence of good news in order to actually get a decent snapback.
Yeah, and I guess one of the points that the guy's making about the VIX at 20, which was really averaging, for the prior year, maybe 13 or so, is that, in this week alone, we have CPI. It's been a market mover, over the last few months or so. The implied move into Friday, up or down in the S&P 500 is about 2%, which is obviously much higher than it had been prior to that. Guy, thoughts on what's more important this week, CPI on Wednesday, or some of the things that we might hear from a Walmart or a Home Depot as it relates to the consumer? Because I think, to Liz's point about that initial jobless claims, I mean, one of the fears is that we're seeing U.S. employers kind of put the brakes on hiring right now, and obviously the implications for the consumer are going to be big. And so when I think about a Walmart, we've been talking all year about this trade down. It's actually been the last 2 years, right, of kind of higher end consumers working down to Walmart. Home Depot, kind of interesting to me too, because even with mortgage rates coming down here in the US, we're still seeing prices pretty weak. And I think that's also, has something to do with a weakening consumer, Guy.
Yeah, I always think that a CPI will be bigger than any individual stock. So I do think CPI is still important, but to a certain extent, I think the market's figured out how to, discount or navigate around some of these inflation prints. But I'm still one of these people that thinks inflation is a problem, and I don't think that dragon's been slayed. With that said, given the run that Walmart's had and given some of the commentary around Walmart, I think today, Dan, one of the analysts, and we'll put it in the show notes, put it on their best ideas list, and this has been a stock that's been, pretty Teflon for quite some time. If they start talking about, their customer base seeing a slowdown, or the continued basically drop down to Walmart from some of the higher end retailers, which we've seen for a number of quarters now, I think that's going to sort of reinforce to me this notion that the consumer is not nearly as strong as the market suggests that they are. And so that's something obviously I'm watching as well. I mean, that's not listen, I think Walmart stock is fine, but I think the commentary around Walmart could be a market mover for sure.
Yeah, Liz, this is a kind of interesting note. Bloomberg this morning talking about the contribution, of S&P earnings from Mag 7. So this is something that, we've been tracking John Butter's work from FactSet for a while, talking about just the contribution of Mag 7, making up a disproportionate amount of the expected S&P earnings, which still sits, I think, per FactSet consensus about 11% year over year and about 14.5% expected for 2025. And when you look at some of the data with, we're 80% through S&P earnings for Q2, they're expecting the Mag 7 to have 35% growth, but they're expecting the rest of the 493 to have about 7.5% growth or so. So basically, that's been higher than it's been over the last year. That is a broadening out. We talked about this broadening out into the stock market away from Mag 7 over the last, month and a half or so. How do you think about that? And those other 493 are obviously, I think, a lot more susceptible to a slowdown in growth here in the U.S.
Right, because in that bucket, you've got a lot of the cyclical stocks, a lot of the goods-heavy stocks, and they are obviously a lot more sensitive to movement in the economy. So first of all, let's talk about the good things about that. The good things are there were a few quarters in there where if the Mag 7 didn't exist, earnings growth would have been negative. So the fact that we've come out of that territory is definitely a positive. A lot of the tenets of a bull thesis right now, or at least a soft landing thesis, rest upon the idea that the other 493 can start generating earnings growth, carrying their weight at least through the end of this year and into 2025, so that we're not so reliant on the Mag 7. That seems to be happening, but there's going to be an adjustment in just what we're used to. So Mag 7, if they're kicking out 35% earnings growth, and we have to adjust down to an expectation of the other 493 stocks only kicking out a meager 7 to 10% per quarter, that's just an adjustment in expectations for investors. And it also requires us to ratchet down our return expectations, because the amount that you're going to get in return off of slower earnings growth is obviously going to be smaller than what we've seen. So I think there's going to be now it doesn't mean that there has to be something terrible that happens, but there has to be a mental adjustment of what are our expectations for the following 12 months? What are our expectations for 2025? If we do actually secure a soft landing somehow, that's not my base case, but if we do happen to secure it, return expectations are still going to be muted because of where PEs are and because of where we probably need to get used to regular earnings growth hitting.
Guy, on Friday, the conversation I mentioned with 22V's Dennis DeBuscher, we had him on last year. We had a great conversation then. When the consensus call was for a recession, let's say in the next 12 months or so, he pushed back on that, didn't see that happening, okay? He's back with you guys again this past week, and he says while he doesn't think there's going to be a recession anytime soon, he has less confidence than he did a year ago. Talk a little bit about that, because we've been discussing this on the pod for the last few months or so, and especially last week when we saw that sort of downside volatility, the R word quickly came back into the conversation. And so again, he seems to be an outlier, but man, he came with the goods, a lot of data that are supporting his non-recession call.
Yeah, and people should go back and listen to that. I think we had Dennis on in July of 2023, and he was very confident in the fact that he did not see any recession in the future. And that, if you go back and remember, there were a lot of people that were on the other side of that fence. So he proved to be correct. And what he does is, he takes all the numbers that we look at, then he sort of looks at second, third derivative of those numbers and why you might be able to sort of punch a hole in some of the thesis. And we talked about the SOM rule. We talked about a bunch of different things, but he was able to sort of combat some of the concerns that both Danny and I had. But with that said, I don't think he was as confident this time around in terms of a downturn as he was last time. Last time, he didn't see it at all. This time, I think he sort of is more not accepting, but I think he sees more of a runway for that to happen. He's still pretty confident in the economy and subsequently the market, although quite frankly, I don't think he sees the return portion of the equation nearly as aggressively or nearly as robust as he saw this time last year. So, again, I think he's less confident, but still confident. But in terms of the market, limited upside. That was my biggest takeaway from the whole thing, Dan.
Yeah, Liz, and I thought that was really interesting too. He made a very clear case of why we could hit a soft landing, and he basically talked about a lot of the things that we've been talking about over the last 6 to 9 months. What happens when you get an uninversion of the yield curve, and where nominal rates are, and all this sort of stuff. And he seemed fairly confident about something that looks more like a soft landing than a hard landing. And I'm just curious. So Guy has been spot on with the unemployment rate going from 50-year lows at 3.6, quickly getting above 4%. It feels like the trajectory is clearly, on its way to 4.5, 4.6%. You think about that, how quickly we've seen, what might be, a full 1% rise in not so long. You just said that your base case is not a soft landing. How do we get there? Like, is it the U.S. consumer? Is it global growth doesn't come in? Is it, what's going on? Because I want to hit this one article about U.S. refiners, tapping down on their kind of oil production and what that might mean for a glut, in the not so distant future. And I just mentioned this, that Dennis, he likes oil looking out a year. I think he thought that maybe we're at $80, $90 a barrel. We were just in the low 80s before we had that dip. So what are some of the things that you're focused on that would cause you to think that we don't hit a soft landing? And maybe it's not the worst landing, but it's just a bit rockier than maybe the soft landing crowd think.
Yeah. So first of all, I like energy too, just to be clear. It's not that I'm pounding the table on all defensives. I do like energy in this scenario, particularly because of what I think is going to happen with the yield curve. So to answer the question first, why is soft landing not my base case? It's not to say that terrible recession is my base case, but first of all, as somebody who looks at history, it does matter. Now, it's not always going to happen exactly the same way, but I find it very, very difficult to believe that it's not going to happen at all. So when you look at things like the Fed cutting rates, you look at inflation coming down maybe a little faster now than we thought, the unemployment rate rising maybe a little faster than we thought, definitely faster than the Fed thought. We know the consumer is pulling back. The order that things happen is the consumer starts to change their behavior before we see it in growth numbers. We already know the consumer has started to change their behavior. If nothing else, just being a little bit more discerning about what they're buying and where they're buying it. The next step is that they pull back entirely. That's what comes out in the growth numbers. And that's what starts to come out in corporate earnings. So there is a sequence of events that occurs, and it takes a while for that to happen. I think for the rest of the year, the labor market holds the key. It holds the key to sentiment. It holds the key to the market reaction. It holds the key to the Fed's reaction function. And it absolutely holds the key to what the consumer will do. Because even if they haven't lost their own jobs, hearing that somebody else did or seeing those numbers rise faster than they expected, the unemployment rate, it shakes sentiment. And it certainly did a couple weeks ago. It definitely has the propensity to do it again. So that's what makes me nervous. And then just the market stuff that's going on. We've talked about it so many times. It's not the inversion that gets you, it's the re-steepening. And there's actual data to back that up. If you look at the stock reactions during the re-steepening periods, they're on average negative, whereas the stock reactions during the inversion periods are positive. That period is now behind us. And I think we're going to re-steepen. We will come out of inversion before the end of the year and stay there. That's usually something that's difficult for the market to digest. So I think this is a period where we're going to have to go through a digestion process. We're going to have to go through another shakeout. Volatility is higher than it was before. This is a different market environment, and it's on top of dealing with a global slowdown.
Yeah, I want to just echo what Liz is saying. I do think the employment picture, I think that holds the key for the rest of this year and for the majority of next year. And Elizabeth talks about it all the time, and it's this sort of the escape velocity in terms of the unemployment rate when nobody sees it coming. That's what we're about to see. And it's not just me and Liz. Larry Summers has talked about this. A number of people have mentioned the same thing. So, the Fed, the same way the Fed, I believe, thought they could control inflation, which they obviously could not control, is probably the same way they think they can control the unemployment rate, which I think we all would agree they want to be higher than it is, but not necessarily much higher than sort of 4.8 to 5%. They think they can get it to a sweet spot, but the reality is they can get it there, but they're not going to be able to stop it once it gets there. And one of the interesting conversations or talking points with Dennis was, I thought the unemployment rate could get to 4.8% by the end of this year, and I'll stand by that. He does not see that happening. He is a much more, I guess, optimistic in terms of the picture. So we'll see how it shakes out. But, I'm in Elizabeth's camp. I think the unemployment rate is going to surprise people. And I think we saw a glimpse of what that can do to the market a week or so ago.
Yeah, it's one thing is interesting about the inflation picture. And again, the Fed was late to it in 2021. And maybe they were late, obviously, to take their foot off the pedal right now. I know, Guy, you don't agree with that, as it relates to inflation and rates and the like. And I thought this quote, it was a tweet from Torsten Slok from Apollo, which, Guy, if I recall, he's been on Fast Money over the last year or so, and he sounded kind of bearish on the economy, but this tweet does not suggest that. He said that there are still no signs of a U.S. recession, and the U.S. economy is doing just fine with steady growth, restaurant bookings, air travel, hotel bookings, credit card data. In short, Fed pricing is wrong, and the market is making the same mistake that it made at the beginning of the year. And so when I think about that comment, again, I think that for the next couple quarters, things do feel okay, unless you see just a very sharp increase of unemployment, or of the unemployment rate, which who knows? I mean, it's been kind of inching higher. And I'll just say this about inflation, and I get it, the cumulative aspect, but man, if you think about the makings of this inflationary run that we've had over the last few years, it's like nothing that any of us have ever seen. You know what I mean? And then the supply chains, the way that they were disrupted, and then the geopolitical impacts of just our dealings with China, what went on with Russia's invasion of Ukraine, what's going on with the Middle East and the like. You know what I mean? So like all those things, to me, I think there's a good chance that maybe inflation settles at a much higher point than their target of 2%. But that then might mean, well, where are real rates? And, Dennis made this point, is that wage growth has has still been pretty good to offset some of these inflationary sort of situations. So again, I'm not going to make the mistake. I'm not a freaking economist or anything like that, but I got way too bared up in 2022 about the impending recession. And I wasn't alone, and it was taking its toll on the stock market. We did have an earnings recession, you know what I mean? Like, we just didn't have the economic recession. And to the point is, there's just a lot of stimulus in the first half of 2023 as it related to the regional banking crisis that, guy, we just did not expect.
Silicon Valley Bank wound up being the most bullish thing that happened to the broader market over the last couple of years, without question, because to your point, it allowed the powers that be to obviously sort of once again reliquefy, I guess, if that's a term, the system. So as negative as it seemed, as negative as it probably could have been, again, it was a catalyst for the rest of the year. And I think to a certain extent, that liquidity has been still sort of sloshing through the system. I didn't see the Torsten Slok tweet, but I'll say this. I think reading between the lines, what he's saying is the market's too optimistic about rate cuts or the amount of rate cuts over the next 6 months or so. Again, we'll see how that plays out. But Elizabeth talks about this all the time as well. Be careful what you wish for, because if you do get those rate cuts, it's not going to be for the reasons you want or you think.
And I am in the camp that if the Fed wanted to do this and send the message that they were gradually normalizing policy, they should have started already. So if that was the intention, I do think they're late to this party. And now we're running the risk because we're on this like teeter-totter of economic data where right now everything is good. And to Torsten's point, right now there's no evidence of a recession, but there never is until you're already in it because the data is backward looking. That's how it works. So the market usually sends some signals, some risk off signals, and we're seeing some of those. I think there's a tweet that we were going to maybe highlight of mine from last week about all of the cyclicality ratios having come down since the beginning of July. So the market starts to send these signals. And it's happening. And I think that's important to watch. But the evidence of an actual recession, including by the NBER, the official callers of recession, it doesn't happen until 6 months later. So we're not going to see it in the economic data right now, but we're teetering on the edge of everything is fine right now. But if it goes too far in the other direction, that's when I start to worry about escape velocity. That's when the market will get nervous because suddenly the data is too cool. So we would need to keep it right about this level for an extended period of time in order for me to say, okay, you know what, soft landing it is.
One thing when I think about that, when we go back to you mentioned Jackson Hole is so that Fed confab or whatever, in the past 10 years or so, we've seen some kind of specific language about how the Fed might pivot one way or another. It's been a big market mover. And I just said that the implied move between now and Friday's close in the S&P 500 is about 2%. And it's kind of shocking that, the implied move between now and the end of next week, which will include Jackson Hole, is only about 2.5%. And so it's one of those situations where we know we're talking about an elevated volatility, guy. We're saying that the VIX now at 20, which is, by the way, the long-term average since the VIX was started in 1990. So just think about that a little bit. But if you're looking to make a directional, play in the S&P 500 between now and next Friday, right now the September Fed funds futures is pricing in about a 50% probability of a 50 basis point cut between now and the September meeting, and nearly 100% probability, obviously, of a 25 basis point cut. Guy, if the Fed is a bit more hawkish, okay, we know what the potential will be because the expectations that they're going to be a bit more dovish. But then if they're a bit more dovish because of growth fears rather than for what they can do, a mission accomplished on inflation, I think all of us think that's kind of out the window. That was the kind of best case scenario a few months ago. They're going to say that, we told you we're going to start cutting rates before inflation gets to our 2% target. But now if it's more of growth fears, you know what I mean? Like, again, that shouldn't be the thing that causes the stock market to rally. And then again, going back to the options market, it seems pretty cheap for protection right now, despite a 20 VIX.
It does seem cheap, but then, I go back to this interview that Leslie Pickard did with Jamie Dimon last week. I think they were in Kansas City. And one of the many things that Jamie Dimon said was, and you know what, I sort of agree with them. The market or the pundits or participants put far too much stock and emphasis parsing every single word out of the Federal Reserve. And maybe we should be a little less focused on what they say and what they do. And maybe it's not as market moving as we all like to think. And, I thought a lot about that, and it actually makes some sense. I mean, we hang on every word, seemingly waiting for these meetings to happen, thinking it's going to be market moving. And in retrospect, maybe we should be focused on other things. But I'll say this, whereas I'm so with Elizabeth on this one, nobody sees the recession coming until it's in the rearview mirror, it's right in front of you. And I think that's what we're seeing right now. I understand, all these people saying full speed ahead, everything is fine, but you sort of dig a little bit deeper and you see the leverage in the system in terms of credit card debt and those different things. The unemployment rate, I think, is going to surprise people. The negative revisions we've seen along the way, basically just people's feeling about the economies in general, and obviously throw in sort of the geopolitical stuff that continues to be out there that nobody seemingly wants to talk about. And again, I don't think it makes for such a healthy brew in terms of the economy or the market, Dan.
All right, Liz, we have some retail earnings this week. What do you expect to hear out of Walmart and Home Depot? Two very different stories if you think about it. Walmart is almost like a consumer staple. The stock's up 30% of the year. It's down 5% or so from those recent highs. So again, it got caught up in the bit of the market downturn that we saw from an all-time high. And then a Home Depot, which seems much more discretionary, which is kind of unchanged on the year. And again, if we hear some sort of sour comments from either of them later in this earnings cycle, that might cause some investors to kind of get a bit more bearish on the consumer.
Yeah, I mean, I don't think there's anything that either company is going to say that would be a total shock to the narrative that's already falling into place on the consumer. They're obviously very different in what they're selling and who they're targeting. The Home Depot thing could be interesting, and I don't know which direction this might go, but let's say Home Depot comes out and has weak results or has weak guidance because of what's happening in its stores and that consumers are not buying as many durable goods. That's always what you want to listen to out of stores like that. Are they buying the durable goods, so the bigger ticket items, or are the sales really just coming from smaller stuff? Because that's usually a shift too. But what could happen is if things are really weak for something like Home Depot, people might get enthusiastic that means the housing market is cooling and prices may actually come down. So that could end up being some sort of positive from a backward view. The Walmart story, I think, is one definitely to pay attention to because of the level of prices that consumers seem comfortable paying right now. What we want to hear from them is what people are spending on, where maybe they've pulled back. And I think one of the other things that's been interesting about Walmart too is how much they're selling in grocery, because consumers have traded down to the Walmarts of the world as inflation went up into that grocery section, and just what's the makeup of their sales. So both of these are going to be very important. I don't think the consumer is in any terrible trouble right now, but I do think that we'll look back on some of these results and the guidance from companies like that in quarters to come and say, okay, that's where the shift started to really occur, and we needed to pay attention to it.
Yeah, hey guys, so we talked about the Mag 7 and their contribution to earnings in Q2. And again, how, let's say the 493 are making up some of that ground, at least backward looking. I look at this Mag 7 and week over week, from the Friday close, none of them have really made up too much ground. There's one this morning as we're talking, it's, 10:30 a.m. Monday morning, NVIDIA's up nearly 5%. That's really the only one that's staging a little bit of a rally. And again, they don't report until August 28th. That's going to be something that a lot of people are focused on. But this week is kind of interesting to me, Guy. AMAT reports. Okay, so AMAT is a equipment provider to semiconductors. All right, so when you think about fabs being made, these guys make the tools that basically make the chips. And when I look at their customer concentration, Samsung is their largest customer, followed by Taiwan Semi at about 10%, Intel at 6.5%, Micron at 3.5%. And so when I think about that, Intel is obviously a disaster. And again, this company is getting billions and billions of dollars from the US government to make fabs, but we know that takes 5-7 years or something like that to do that. Taiwan Semi is interesting because Taiwan Semi is obviously makes 85% of the high-end GPUs, right? That are needed for training, these generative AI models that go into the servers, that go into the data centers. Is this name interesting to you? Because it's fallen off a cliff. It's down 25% from an all-time high just a few weeks ago.
AMAT is very interesting to me. To your point, this was a $255 stock. I want to say on July 12th or thereabouts, we traded down below 180. I think we got down to 175 or so last week. It's pretty precipitous drop. So the good news is, if there is good news, we traded down basically the levels that we saw in April. Like, by the way, a lot of other these stocks, those April lows turned out to be the low for a lot of different things. And we traded down to those levels last week in AMAT. So the setup is much better, but it's a commentary to your point. We heard some really constructive things out of Taiwan Semi that I think the market sort of was, I don't know, bolstered by, or at least assuaged some of the concerns around the sector. The flip side of the coin is, we're starting to see, you're starting to see margin degradation with some of these really important names, which I think at a certain point are going to affect the entire AI trade. So, look, the commentary around AMAT's going to be really interesting. I think the setup is as best it's been in a while. But I'm looking at it more in terms of a gauge and as opposed to something I'd rather trade into earnings this week.
Yeah, and I agree with you on the setup. And it's just, if it was a trade and maybe you look to define your risk, look at a call spread or something like that. Liz, really quickly on small caps, we spent a lot of time talking about the underperformance over the last 2 years. It felt like, from July 10th, it had a 12% move. It was trading at multi-year highs. The Russell 2000 got to 2,300. And then in the last, week and a half, it's given back that entire move. So we talk about this rotation. People were all geeked up that, small caps joined the party and what that means, right, for at least a stock market that was broadening out. We made the point on many occasions that the Russell 2000, its total market cap is less than that, Microsoft or Apple, and we just didn't think it as that important. What do you think, about the sort of hands, let's say, that the Russell 2000 has been in over the last month? People were happy to chase it, but they were very quickly to get out of the trade.
Yeah, well, a couple things. So if you look at that chart, the steep rise in the Russell 2000, that's where the hands all came in, hand over fist, trying to buy that index. It was going to finally break out. This was attempt number 6, and number 6 was going to be the charm. And here we are. All of those same hands, I think, gave it right back, and we have just as steep of a decline on the other side. So it's this little blip on the radar of an attempt. And just thinking about this from a little bit longer term of a view, not even that long term, we are now at a point where year to date, the Russell 2000 is up 2.15%, and the S&P is still up 11%. So as much news as small cap made for this comeback tour, it wasn't successful. So that's one of the things from a market perspective, like I referenced before, we don't have signs of a recession in the economic data. From a market perspective, small caps still not being able to stage a durable rally is an indication to me that we are not early cycle, that we are not mid-cycle, that we are still late cycle, and the risk behavior when we get a little scared sends things right back down the same way that they went up. So I understand the enthusiasm. I understand the trade as rates fell and the reasons why people bought small caps. And yes, small cap earnings are supposed to get more positive into 2025. So it also seemed like there was fundamental reason for that move. But small caps are so sensitive to the economic cycle, you cannot discount that no matter how strong the fundamentals seem under the surface.
Well, real quick before we get out, 100%. And, I like Liz, I understand why small caps rallied. It was a catch-up trade. It was yields going lower. It was exuberance around, hey, maybe we are early cycle, until people realize, well, wait a second. The economy is slowing. The unemployment rate is going higher. These are still economically sensitive names. What are we doing here? And I think the about face is going to be something we talk about for quite some time. So in terms of the Russell, that move, it was at 206 or so in the IWM up to close to 230 or so, right back down. I think that's something we're going to be talking about for the remainder of this year and early next year, as how that was a false breakout on the back of rates going lower, but not necessarily the economy improving.
All right, last thing before we get out of here, Guy, and I'm wondering if you think that we're going to start to see more activist investors get involved in some names. We know that Starbucks very recently, JetBlue, was targeted by Carl Icahn earlier this year. And it's interesting that Starbucks is up 4%. I saw a story, about, activists going to start pushing. This is a company that has massively underperformed the broad market over the last year and a half. We've been talking about Disney. We've been talking about Nike. been talking about Lulu. So a lot of consumer discretionary names not acting particularly well. But the JetBlue one is interesting, guys. So we know that there's been, I think, a couple activists. Today, the stock is down 12% or so, downgrade from S&P. So we just talked about how, some of these consumer-oriented names, or we read the Torsten Slok tweet that actually spoke to that, about bookings and hotels and cruises and airlines. This is kind of interesting that we're starting to see a little bit of the ratings agencies get involved in some of these names. I don't think we've seen, this sort of downgrade in a while.
Well, they're doing their job apparently for the first time in a while. You're right about activists. I do think you're probably going to see more and more of that into next year as, some of these stocks suffer and people see opportunities sort of come in and try to take some sort of management role. I don't know necessarily if JetBlue is going to be that interesting. I know a lot of different people have tried in the airlines over the years unsuccessfully. I do think, as Tim Seymour says all the time, they're trading vehicles. But you mentioned Starbucks. There's definitely going to be people that think they can fix it. But, quite frankly, in terms of Starbucks, the stock, I think the genie's out of the bottle. And I don't think they're going to see the valuations that they enjoyed for so long when they were a growth company. And now they're going to start to have to figure things out on the other side of growth. And I don't think, listen, historically, that's not been easy for companies to do.
All right, last thing, Liz, if we have a firm PPI and CPI this week, where does the S&P close? So we have an S&P that is 53.67. It's up about 200 points from the lows on Monday. We have the S&P up 12.5% or so on the year. So we made up all those losses as we discussed from early last week. Things seem just okay in the S&P 500. We had a little bit of a cleansing with some of the most crowded stories over the last few weeks or so. So firmer data or just in line, is that enough for the S&P 500 to kind of hold ground?
I think it keeps it afloat, and I won't give a target, but yes, firmer data or even a little bit stronger data probably keeps it afloat and drives a marginal rally through the week. Because I think, again, this is a new environment where people are more scared about a growth slowdown than they are in a resurgence in inflation. So I think what we would see is big movement in the Fed funds futures, probably only pricing in one cut for September. Of course, that could all change when we hear from Powell at Jackson Hole. And remember, that's the first time we're going to hear from him since that scary jobs report and since the Japanese yen debacle. So there's a lot that's going to be listened to in that speech. But also, this CPI report, if you remember the last CPI report, that was the first negative month-over-month print that we had. This month-over-month print is expected to be positive. In the last CPI report, that was cooler. The market started to like it in the morning, and then we gave it back and actually ended the day down, which was a change of tone. So I think we have shifted to, if things get stronger, the market will like it.
Yeah, I think that the market is probably flat until we get into Jackson Hole. That's just my 2 cents, because I think that folks are not going to overinterpret the CPI, waiting for, to see what Fed Chair Powell has to say if there's any sort of divergence from what the CME Fed Funds futures are pricing. But here's the good news, Liz. You're back with Guy and me on Market Call on Wednesday at 1 p.m. Eastern, and we're going to be able to go over all this data and see if the market is reacting. Guy, you and I are going to be on the Market Call tomorrow. That'd be Tuesday with Carter Braxton Worth. And again, every day, Monday through Friday, we drop this special little podcast that we call what, Guy, Adami?
We call it the Market Matrix, Dan, narrated by Brunson.
Yeah, you love that. So it's the MRKT Matrix. We curate what we think are probably 10 of the top business and market stories. We bang them into a large language model. We get a bit of a summary. We put it into a voice bot. Like Guy said, it's Brunson. Go find it in your favorite podcast store. Download it, rate it, review it, share it with your friends, Liz. That's how people will find it. So we appreciate you guys being with us here on a Monday. We'll see you all on the Market Call later on this week. And obviously, the On the Tape Friday edition will drop early that morning.